Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Russell Thompson with H&R Insurance and Financial Services, and we'll be talking about how life insurance fits into retirement. Russell, welcome to the program.
Thank you.
Hey, so I want to hear all about this because I think when people hear the word life insurance, they cringe, and I want to hear how it fits into retirement because that sounds like it's a plan and a strategy. But before we dive into that, give us a little bit of your story and background and how did you get into the industry?
Well, I was in construction for 24 years, and I worked in a steel mill in northeastern Kentucky for 16 of that. And the writing was kind of on the wall that they were going to shut it down. So I decided to go ahead and start getting educated in an industry I had a lot of passion in. I had a lot of passion for the stock market. So just doing Google searches kind of led me into how do you get into that industry. And the first step was get licensed to sell life insurance.
Yeah.
So that's how I got into the entire industry.
Yeah, Nate, because sometimes it is just like, hey, I'm going to give it a try. I'm going to see how it goes. And then it just kind of grows on you from there.
Yes. And I was fortunate because I actually did both jobs at the same time for about 3 years until my youngest son graduated high school. And it gave me time to get good at it and learn it without needing the money, actually.
Yeah. Yeah, that is good. Well, Nate, so over time, I'm sure you've, tried some different ways of, let me help my clients accomplish this, that, and the other. And, you're focusing on helping clients retire well. Let's talk about this topic. Life insurance fitting into retirement. Like I said in the opening, I feel like a lot of times people hear the word life insurance and they go, oh yeah, I'm good to go. But really, are they? And how does it fit into retirement? So talk a little bit about how someone, when they pass away, how does that impact retirement income?
Well, the way it impacts retirement income is on the surviving spouse. And I've seen it throughout my life multiple times, but now I have a really good understanding of that impact, and people just don't think about it. So it's when one person passes away, there's income that will be lost. And normally the bills don't go down in direct correlation with that income gap. So you have to plan for that.
I would agree with that. I don't know your industry, but it sounds logical that you would have to plan for that. But there seems to be like a lot of calculation that would go into that statement, plan for that. So how do you help your clients start thinking through that process of planning for that?
Well, it's educating on that loss of income. So when I first meet with someone and they're planning for retirement, and we're going, okay, who's collecting Social Security, kind of who's the breadwinner, and letting them know that when one person passes, you keep the higher of the two. One of those Social Security benefits will fall off. And it's statistics show that it's often just with Social Security, anywhere from 25 to 35% of that household income will fall off just in Social Security benefits. So that's the starting point of the conversation.
I agree with that. And it's like you start getting down into the, the weeds of, okay, how much do I need? And that presupposes that you actually need to know how much will you need in retirement, because if one of the incomes goes away, now we need to close that gap even more. And many times, you can comment on this too. Sometimes people don't know how much they need in retirement, or it's not exactly accurate because they just don't know. How do you help them clarify that?
Well, and that's a great question. It's easy to establish walking through someone's plan of how much they need as a household income. So it's how much guaranteed income do you have coming in? What's your Social Security? And then, your incoming monies, and how much debt do you have when you retire? Are you going to have a mortgage, a car payment? Do you plan on traveling? So you're trying to figure out what the expenses are. So when you do that and they realize, so you're trying to determine, have we put enough back to retire?
Yeah.
Will we have to change some things? Will we have to change our lifestyle? And once you establish that, and you say, okay, now what happens when the first one of you passes away? What's that look like? Because here's what you're going to lose according to what you just told me. This is how much income will go away when the first person passes. And that kind of kicks into, how does life insurance fit into this?
Yeah, because A, do you have enough life insurance? B, is it the right kind of life insurance? So I think that that's a big piece of that puzzle. So talk a little bit about the types of life insurance. I know that there are, term, there's permanent, whole life, cash value, all that kind of thing. When you start having that conversation of saying, okay, well, if one of you is deceased before the other, you will have a gap of about X. How do you start calculating the type of insurance? Because, you got to close that gap somehow.
And that's a great point. The thing is, most people, when they have life insurance, they don't really think about how much they have, what type it is. So it's a great point. Will this expire? Will it go away before you go away? So, and there's tons of different products that fit different, everyone's unique. So one plan won't fit for everyone. So when you go in, you say, okay, they have term insurance. Oh, this will last until I'm 75. That'll carry me out. I will probably pass before that age.
Yeah.
Well, what if it doesn't? What's that look like? So, and then you have cash value life insurance policy and universal life insurance policies. Everything comes with a premium. So term is the cheapest because life insurance companies are good at evaluating life mortality. So when you get that policy, they have a good idea outside of an accident how long you're going to live. So term means it's going to expire and they think you're going to live longer than that. And premiums are based off that. And then with cash value life insurance policies, those cost more because they know they're paying out the death benefit.
Yeah.
As long as you make those premium payments, they're going to pay that death benefit. And someday you will pass and they will be on the hook for that amount of money. So that's the reason for the premium difference. And people are living so much longer now. There's tons of stats that show, how much longer people are living. So it's one of those where you have to explain to them, here's your situation, what you have. More than likely, this will go away if it's a term. And then that's the part that if they do have term that lasts, a little bit longer in life, now maybe when that expires, you're uninsurable or it costs so much you can't afford it. So it's better to have an understanding of that.
Yeah, and I think that goes into the conversation at a certain age, Okay, you've got a term policy that is 20 years. You got it 5 years ago. You're this age. That means when it expires, you'll be that age, which means will your health be good enough? And then let's look at the premiums. When you're now at your upper ages and getting an insurance policy, that's going to be way more expensive. So I think that when someone looks at it through that lens and goes, well, hey, why don't I do something on the younger side of things when I'm younger and get that permanent? You pick up many benefits, one of which is it can never change because it's permanent. And then also you don't need to worry about your health changing because you don't need to re-up or requalify. So that permanent or that cash value has a few of those kind of benefits just right off the bat, right?
Right.
And then what about when you said cash value? Talk a little bit about that because I think that too many times people hear life insurance and they think when I die, I get X or my heirs get X. How does cash value work in a permanent policy?
It's a great question. So when you build cash value, so you're paying in premiums and there's some type of investment instrument inside that policy. So as you're paying in premiums, that money is growing inside some type of financial investment. And you could go for days on what all's inside these. But as that accumulates, it turns into more than just a death benefit because you can access that cash through a loan, which makes it tax-free at some point if you need the money. So you can reach in and borrow some. So if you have an kind of unexpected expense, maybe you need a new roof on your house or your car needs fixed, and you don't want to dip into savings, you can actually go to the life insurance policy and say, okay, if I have $50,000 cash and I need $10,000, I want to borrow $10,000 from this life insurance policy. And then when you do that, whoever you're speaking with will explain to you the impact that has on the policy. But that cash is there for you if you do need it.
Yeah, and I think that's a lot of times people aren't really aware of you're paying higher premiums because it's permanent, but the benefits, we've talked about some of the benefits, but you're actually paying more than what the death benefit would require. So you're accumulating, and then maybe it's tied to some type of a growth index where you're accumulating cash and you're getting some compounding. So that's huge. And then at that point, it becomes a death benefit and a living benefit as well. Because what you just mentioned about loans, you don't need to die to access or tap into some of the benefits of this policy. Talk a little bit about some of those living benefits.
So back to the term life insurance part. Term life insurance is a liability, meaning you're always going to pay that premium and then it's going to expire. Now, if you live past the expiration date of that policy, congratulations, you made it. Mm-hmm. And then you have no more death benefit. Cash value is an asset. These cash value life insurance policies. And they have to be designed correctly, for one. So you need to be working with a financial professional that understands that and knows how to design these policies because they're different than just here's what you pay and here's what you get. There's things you can do there. But at some point, that cash value inside that policy should be, if designed correctly, more than what you have paid in. Mm-hmm. So it's not just a bill. And, you're growing a savings account over time. And when you want to access that cash, you do it as a loan, which keeps it tax-free. But there's lots of living benefits inside life insurance policies that turns them into more of a hybrid vehicle for retirement.
And I think that, like what you said about borrowing against that, that's huge. That's a living benefit, because what if you needed to start a business or send your kid to college, and you've got enough built up in there, then that could be an option. Maybe not every single time do it that way, but I think that's interesting when I hear you talk about these kind of things, death benefit versus living, or in addition to living benefits. That's pretty big. But talk a little bit about, you said the word tax-free. Talk a little bit about some of those benefits for the tax-free growth while it's growing, as well as when you pass on and pass it to your heirs. What are the ramifications of those distributions in that respect?
So life insurance, the death benefit is always tax-free. And the distributions, because they are a loan. So if you go take a loan out, a personal loan at the bank, you don't pay taxes on that loan. Mm. It wouldn't make sense. So life insurance companies are authorized to let you take a loan from the policy, and there'll either be an interest rate, which may be a net zero or 0.5%, or some type of design that different companies offer different things for the loan aspect of it. So as you get into retirement, and if you start this early enough, because it is a long-term play, it takes a while for this cash to accumulate. And like I said, there's different types of policies. But as that accumulates and you get to a certain point where there's enough cash in it, you can do what's called an enforced illustration. And all that means is they're going to say, okay, over the past 15 years since you've had this policy and you've paid these premiums, and here's where your cash value is. And here is the performance of the underlying investments inside the policy. You can stop making payments, and the performance based off historicals of what you paid and the return will carry the policy. It'll pay for it internally.
Mm-hmm.
Or if you want to take 30% of the cash out based off how the policy has historically performed, it's a loan, but you don't have to pay it back. The performance of the cash that's left in there will support that policy with those premiums being paid. So again, it's one of those where you can pay it back, but when you say you have hypothetically $100,000 death benefit and $30,000 cash, and you pull $10,000 of that cash out, it will more than likely drop the death benefit by that $10,000.
Yeah.
So there's a lot of things in there you need to understand if you're going to access that cash. But again, it goes back to the original design. Some people design these and pay more than what they're supposed to pay into it, more premium, so that the cash grows better and they can actually take more money out later in life for retirement purposes or business adventures. There's all kinds of things people use that cash for.
And again, I think we're circling all around the comparison between a typical, what people think of as life insurance, like the death benefit, and now we're shining the light on some of the living benefits and how that actually impacts and benefits retirement. Another big hit to retirement is long-term care, because I've heard statistically a huge percentage of people will need some type of long-term care, and that tends to be pretty expensive. How does a properly structured life insurance contract benefit in that way?
Well, there's riders you add on to life insurance policies. And again, it all depends on the policy, the company, and all that stuff. And a rider is like when you buy a car and you start adding things onto it, upgrades. Yeah. So you're upgrading your life insurance policy so that it does more than just have a death benefit. So long-term care is probably the most, if not one of the most, overlooked aspects of retirement planning. And there's tons of statistics that go into this as far as how many people will go into long-term care. It's a very high percentage, and the cost is just unbelievable. So it's one of those where you add this rider onto the life insurance policy, and the way it's done is they pull from the death benefit, not the cash value. So if you go into long-term care, the chances are you're going to pass soon. So within like 6 months to a year. Now, not everyone, but the studies show that most people do pass within 6 months to a year of going in. But the average stay for a man in long-term care is 2.5 years, and the average stay for a woman is 3.5 years. And that's just a broad range outside of the people who do not pass within the first 6 months to a year. And the cost for long-term care could be upward of $200,000 a year. It just all depends on the facility you go into. So if you fell so many of the activity daily living at ADLs, you qualify. So the same thing for a long-term care policy. You have to qualify for that to pay. So you can't just go into a long-term care facility won't accept you. But if you meet the qualifications to go into a long-term care facility, after a certain period of time, usually 6 months, they will start giving you 2 to 4% a month of that death benefit tax-free to pay for or help offset or pay for those long-term care needs, so that you're not dipping into savings, IRAs, whatever that could disrupt the living spouse's income even more. So, and like I said, there's a 70% chance of all of us at some point needing long-term care.
70% is a big
70% chance.
Wow.
And as people are living longer, that number, I can't speak in absolutes, but no, it looks like that number is going to go up as people are living longer. People are getting medications and treatments that have gotten so much better that people are living way longer than what they did 20 years ago. Life expectancy is quite a bit higher. So if you're not prepared for that and you have a spouse that needs long-term care, it has to be paid for somehow.
Yeah.
So that could drain the rest of your retirement and savings.
Sure.
So and all you're doing is adding it on as a rider to the life insurance policy.
Yep.
And yes, it's lessening the death benefit because it's pulling that monthly. And and it's also tax-free when this happens. Long-term care policies are very expensive, and if someone passes away, there's no benefit to it at all. And there's not a lot of companies that even write long-term care policies anymore. So this is a way to cover that. So when you look at it, you have help with long-term care, cash value you can access, and then you're offsetting an income gap when someone passes. So it becomes so very, very multi-purpose in retirement planning. Covers a lot of areas there.
Yeah. Amazing. Well, obviously this is not something you can navigate on your own, and someone can't just go Google it or ask AI. This needs to be something where a professional sits down and structures everything the right way. So if someone is interested in learning a little bit more and reaching out and connecting with you, Russell, what's the best way they can do that?
You can email me at russell@hr-ifs.com. That's I as in Indian, Frank, F as in Frank, S as in Sierra. Or just go to www.hr-ifs.com.
Excellent. Well, Russell, thank you so much for coming on today. It's been a real pleasure chatting with you.
Thank you. I appreciate your help.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.